Hello and welcome everyone to another market commentary from StashAway. With us today, of course, our Chief Investment Officer again, Freddy Lim. Hey, Freddy.
Hello, everyone.
How are you holding up over there?
Well, in summary, you started becoming much more detail-oriented around the house, paying attention to dirt, cleaning the floor, and also where I should position myself in this conference.
Yeah, it's looking quite good. It looks like, for me, I think it looks always different, but I think you're pretty steady there in your chair. Looks like you haven't moved much since last week, but that's okay. We have lots to talk about, as always. I know I'm repeating myself here, but a couple of good topics in terms of markets and what's going on in the world. And then we also, again, got fantastic questions from the audience. So as always, please keep them coming, right? You can leave them below the video so that we can pick them up for next week as well. With that being said, Freddy, let's go through some of the news items first, right? Obviously, over the weekend and especially beginning of the week, you can see a lot more tension and accusations being thrown around and between China and the US, right? Do you want to tell maybe the audience a little bit more about what you're seeing there and why that's going on?
Yes. The rhetorics, the anti-China, or you call it China bashing, it's always a popular thing to do among the electorates into an election year. Especially so for Trump, who sort of were perceived poorly by the way he handles the coronavirus situation. So he needed something to offset or to pare back some of those unfavorable views on him. And the easiest thing is to go after something that both parties and all electorates would sort of agree with. And the virus started in Wuhan, China, so it's easy to call it the Chinese virus, right? So that's one of the tricks. And in fact, the survey done among consumers in the US, they do show that the unfavorable view of China has been on the rise. So this is a calculated move by Trump.
Yeah, and I was reading even like he's saying that, but even his intelligence committee is not 100% on board with his accusation that it was a lab-grown pathogen, right?
Yes. It did at first stir some initial reaction, right? We had I think last week we have a 4 percentage point drawdown because of that. But what surprises me was the resilience of market since then. We barely moved from that level. In fact, we are slightly up. And it seems to me that the market is now focusing on something else. Perhaps the rate of change with respect to the virus statistics, maybe the potential for the reopening of some parts of the world. So there's a lot of offsetting things that's making the market sort of being in a stalemate situation.
Yeah, no, totally agree on that. And that's what I wanted to talk to you a little bit about, because you can see the opening of some states in the US. In Europe, you see slowly countries like Italy slowly letting people back out, Germany opening up for 2 weeks already. So doesn't it show that the market is being resilient? Also, how much of a forward-looking indicator the stock market actually is?
Yeah, that's been our position all along. And remember that during the lockdown, initially, there was no data, right? People are at home. Who's going to collect data? And who's going to process the data? And also, the data that comes in is unlikely to immediately reflect the full extent of the COVID-19. So what happened back then, remember, we inverted the ERAA's valuation pillar to infer the expectation that's in the price of the stock markets. And we talk about how deeply recessionary they have been. Since the stimulus came in, we have seen the market recover from a deep recessionary territory to an average recession territory.
Yeah, no, totally. And with that being said, I think the other big topic of the week or the last few weeks has been an event that happens only every so often in the Bitcoin world, where we haven't heard too much lately of in the last year and a half probably, but it's called the Bitcoin halving. Do you have an opinion on this, or do you? Because I've been seeing a lot more news items and YouTube videos being shown and things like that. Anything you want to say there?
Yes, halving happens quite a bit. I think this is by design in the Bitcoin algorithms to control supply, because one of the primary objective of Bitcoin is not to suffer from inflation like the way paper money does. So the halving was bigger impact in the first one. Obviously, this is let me see. This is not the first one now. I think this is now the 7th or 6th halving that we have seen, and so each halving is halving less, right? So what happened is each mining company that mines Bitcoin, they get one Bitcoin after they process a certain blocks of transaction. Now, in the halving, when they process the same amount, the same number of blocks of transaction on the network, they get half of what they had previously. So the rewards in terms of units of coin that goes in there is less and less. It hasn't been an issue for Bitcoin for a while because they were coming from a very low base and moving up a lot, right? But now at this sort of environment, halving is still perceived by some amateur investors as being able to jack up the price. And there's been a lot of, I want to caution users against a lot of scams out there. There's a lot of advertisement I've seen in YouTube myself, where you've seen people marketing something like trade of the century, sign
quick
up,
bucks, right?
Bitcoiners, yeah. And we knew he's going to talk about the halving of the Bitcoin, and they are going to try to ask you to buy it, right? So I do not believe that this is something that everybody in the Bitcoin community knows. It's not something that is not known.
So how can it not be priced in, right? I agree, yeah.
So buyers beware, be careful not to react to it.
Yeah, no, I think thanks, Freddy, for that quick explanation, because I know I've been getting some questions about that as well. So with that being said, let's go to some of the user questions we have from last week, and in particular, there's two that we want to answer. It's from Ritz as well as from Tan Yong Boon. They're both talking about kind of the similar question, and they're both concerned about the fact that we saw a bottom, right, already. The markets have recovered quite a bit of that from that point on, and now economic data is coming in not so hot. Is there a potential for a bull trap, like with much further declines coming?
Well, to be fair, I can have spend 10 days talking about the bull side. I can also spend 10 days cherry picking and tell you a whole lot about the bear side. There's a million views out there on both. And the StashAway approach is to root ourselves in data and an investment framework. So what happened is that the data was in a blackout period. We know it's going to open down a lot, right? So I mentioned that earlier, we inverted our valuation pillar to infer what's in the price of the market. In principle, if the market price is already pricing for a recession, you do not position for a recession. If the market has not, and things are worse than what the market expects, then you would position for it. So it's always a quadrillion thing, because the market is a fast-moving voting engine. It's not stupid. It's a collective wisdom. Everybody around the world who traded or buy or sell something in the market all over the world has voted today, and that's your closing price today. We can't say that I'm smarter than all the people out there and the market is wrong, right?
Yeah.
But instead, we can use the solid investment framework to say what's been priced in the market, and is that a reasonable pricing?
Yeah.
And as I have said, I think as we have done in our CIO Insights, we actually talk about 23rd March, the worst case, the market was pricing deep recession, and then the policy stimulus came in, market revised it upward to an average recession, and the actual numbers that came in around late April exactly confirms that market pricing. So the Conference Board Leading Economic Index came in within 0.3 percentage point difference from the market's expectation.
Yeah, we can put that CIO Insights link in the comment section as well for people to have a read on that, because it was quite interesting analysis.
So
on
just
that
to
topic.
complete the loop on this one quickly is who knows the future? But again, we always just maintain the same discipline. As data comes in, we evaluate it. And today we're in a stalemate. Policy stimulus has helped, but we're not completely out of the woods yet, right? So and just to clarify, StashAway's portfolio are in all-weather strategy for everywhere outside the US at the moment.
Thanks, Freddy. So hopefully for Tanyong and Ritz, that will be a good answer. Let's go on with the last question for today. Jason Lim, he is asking, Freddy, what do you think of the way some economists are claiming that equities are likely to go down because baby boomers are retiring more and more, and when they retire, they will start drawing down their pension funds. Do you see any kind of relationship there?
Well, we can use the same argument 5 years ago, 10 years ago, or some people can say, well, millennials, there's more and more millennial investors whose participation in the stock market is not as much as those soon to be retired. You can also flip it the other way around, and yet the market went from 2,000 many years ago to 3,000 handle, right? So it is very difficult to make solid investment decision based on just a viewpoint like that. So that's the first point I want to make. So we rather focus on economic data, leading economic indices, the valuation asset classes, and we also want to focus on risk management, building those portfolio insurance in day one, right? So that's, I think, the more important focuses. But back to the question, I would say that baby boomers, when they retire, it doesn't mean they will not invest either. These are people who saved up their whole life and now they're getting lump sums. And they are 401k, they may draw on it, but they also have needs, because when you are retired or not, you still have risk of being eroded by inflation.
Exactly.
The retiree need to invest in something.
And especially nowadays with the life frame of a human being, the life cycle, we live so much longer, right? So retirement is longer, which also means, hey, if you have a 30-year retirement ahead of you, you still need to beat inflation, right?
And I also would say it's not just about the stock market, right? I mean, we deal with asset classes, there's resources, because there's commodities, there's bonds of different credit ratings, and there's so many asset classes out there. I mean, the need for baby boomer to invest is actually as much as anyone else. They need to be worried about inflation, so their portfolio could look different from someone who's younger and more focused on growth, right? So for me, I think for a diversified portfolio approach, even if this is a valid concern, it's not a concern if you are very diversified. If you are just focused on secure stock market investing only, it is a higher risk, right? In a way, if you look at it that way.
Oh, thank you, Freddy, for clearing this up. So hopefully, Jason, that's a good answer for you. If not, keep asking questions. We welcome everyone to do that so that Freddy and I can get to them week by week. Anyways, Freddy, thank you so much for, again, sharing the stage here today. Really appreciate you dialing in. For everyone else, we'll be with you next week. Other than that, hope you have a good rest of the week. There's a holiday coming up as well. So we'll be again soon with you next week. Bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.